So in part two, what we're going to talk is the code of professional ethics. What are the code of professional ethics for a auditor? All of the CPA, provincial bodies, and the IF, International Financial Accounting Committee, have their own rules of professional conduct. So definitely every province or every regulating body under their jurisdiction, they have their own standards or their own rules. So typical framework follows that introduction and purpose, fundamental principles and standards, general rules, specific rules, disciplines, and interpretation of the rules. So this is the framework they have to follow while doing auditing. The CPA Ontario members handbook summarizes the five fundamental principles. Why we emphasize on the Ontario's members handbook summarize, because our stock exchange is in Ontario, and most of the corporations who are trading in stock exchange is registered or incorporated in Ontario Board of Securities and Exchange, and they are also have to follow the that. So CPA Ontario members handbook summarizes the five fundamental principles like this. The first one is a professional behavior to serve the public interest and maintain the good reputation of the profession. Integrity and due care to perform professional services with integrity and with due care. Professional competence to use the required skills and training, including maintaining your competence over time through continuing professional education and competence. Confidentiality, not to disclose or exploit confidential information acquired as a result of a professional work or relationship. And the last thing is objectivity. To main objectivity in all professional services, meaning members' professional judgment must not be impaired or perceived to be impaired with respect to the assurance services. For example, audit. The special term independence is used instead of objectivity, that whatever you are writing, whatever you are making, doing audit, you should be independent. That's a independence of your work is very much required. Code of Professional Ethics, International Financial Accounting Committee framework for a code of conduct. Objective to serve the public interest. That's the objective why they developed this code of conduct. Principles necessary to attain objective. Integrity, objectivity, which can be independence, professional competence and due care, confidentiality and professional behavior. Conformity is achieved by identifying, evaluating, and controlling threats to non-conformity to an acceptable level. Now, how the Code of Professional Ethics, IFSC framework, resolving a conflict. If there is a conflict, how they can resolve it. The conflict can be with the auditors and the management. Members should consider the following: identify the relevant facts, identify the ethical issues involved, identify fundamental principles related to the matters in question, identify established internal procedure, and identify alternative course of action. The step two is identify the appropriate course of action consistent with the fundamental principles. And step three, if the conflict cannot be resolved consistent with the fundamental principles, then the auditor should refuse to be associated with the conflict whenever possible. Rules of a professional conduct. The rules of a professional conduct drives their authority from the bylaws of the various CPA professional bodies. Rules apply to members and all persons associated in public practice, including employees and partners. Certain principles apply to all professional accountants. Serving the public interest. The single most important principle is that accountants must serve the public interest. The profession must maintain a good reputation at all times. If a professional accountant is convicted of a relatively minimal offense or a fraud, his or her certification is usually revoked. That's a criteria that. Integrity. Integrity is the duty to be honest and consciously in performing professional services. A public accountant must be upright and not be kept upright. That's a way that it should be. Independence and objectivities are closely related terms, and objectivity, member in public practice shall hold himself or herself free of any influence, interest, or a relationship that impairs the member's professional judgment. Any type of relationship that affects the professional judgment, that is against the objectivity rule of the code of conduct. Independence, objectivity is a case of an assurance engagement. Now, the term independence is used in the Canadian Business Corporation Act as a key qualification of an auditor. Like, auditor has no relationship with the management in any capacity. So the qualification of auditor subject to the section 5, a person is disqualified from being an auditor of a corporation if he is not independent of the corporation. Independence for the purpose of this section, independence is a question of a fact, and a person is deemed not to be independent if he or his business partners beneficially owns or controls directly or indirectly a material interest in the securities of the corporation or any of its affiliations. So in short, we can say that any type of relationship is not good with the auditor and the corporation. Independence, for the purpose of this section, we continue to talk about the independence, and beneficial owns or controls directly or indirectly a material interest in the securities of the corporation or any of its affiliates, or has been a receiver, manager, liquidator, or trustee in a bankruptcy of a corporation or any of its affiliates within 2 years of his proposed appointment as an auditor of the corporation. So this law or a rule or a code is very clearly specifying that it should not be in any relationship with the corporation, and it should not be in relationship in the past 2 years. So that's the way very clearly mentioned. Duty to resign. An auditor who becomes disqualified under this section shall subject to subsection 5 resign forthwith. Independence standards, the IFAC and CPA, provincial and territorial bodies all have an independence standards framework based on 5 threats to independence. Self-review, providing assurance on their own work. Self-interest, for example, benefiting from a financial interest in a client. Advocacy, promoting a client's position or opinion. Familiarity, become too sympathetic to a client's interest. And intimidation, being deterred from acting objectively by actual or perceived threat from a client, that you intimidated the auditor that don't report this, otherwise the consequences are very bad. So by this way, that's normal. Familiarity is also not working, because if you have any sympathy for the corporation. Independence, the Canadian Business Corporation Act requires independence for auditors. Many other services offered by public accountants are also required independence. A member is considered to be in public practice if he or she let it be known publicly that they are a PA, public accountant, and offers the type of services rendered by other PAs. CPA in the public practice are referred to in the text as PS, public accountants or certified public accountants. It's the same thing. So the concept of independence is critical to the public accounting profession. Not only must be an accountant be independent, in fact, he or she must also appears independent to others. Independence, in fact, is a mental state, and it's difficult to prove. Independence is appearance is governed by the legislation and rules of professional conduct. Other issues related to independence that can be possible while doing audit. The first one is direct or indirect financial interest in the client, any type of financial interest. Permitted loans within a client's normal lending terms. Honorary position in non-profit organizations, retired partners, accounting and other services, bookkeeping and assurance services, rotation of partners and second partners review, actual or threatening litigation, investors or investee relationship, effect of a family relationship. So these are all the possible relationships that can affect the independence. Permitted loan, That's what we just mentioned here, that there is no relationship of a borrower or lender. The accountants will not be deemed to be in a conflict of interest for home mortgage, like uh, immaterial loans or secured loans made by the financial institution to the accountant under normal lending procedure terms and requirements. Otherwise, independence would be impaired by virtue of the financial relationship between the auditors and the lenders. So, if an auditor is auditing a bank and he has a mortgage loan from that bank, that's a normal thing. If it's a very small type of loan, immaterial type of loans, very small minor loans, that is also not creating any problem. Secured loans made by financial institutions, if it is a secured loan against this stocks or bonds or these type of things, then it has no problem. But if there is any other type of a loan which is not secured, which is of a huge value, or which is other than the mortgage loan, then this relationship is considered to be the affecting the or impairing the independence. So independence also is not impaired by a member obtaining auto loans or a lease collateralized by the automobile, insurance policy, loan based on surrendered values, loan collateralized by the cash deposits or credit card balance. So these are the they again further elaborate or classify those loans that are not considered to be uh, uh, loans that affect the relationship or independence of the auditors. So if the loans are made in a normal course of business for the insurer. Then comes the honorary position in non-profit organizations. Honorary position in non-profit organizations, public accountants' independence is not impaired if the member is an honorary director, where criteria are met. The position is purely honorary. The CPA is identified as an honorary director or letterhead and other literature. The only form of participation in the use of CPA's name, and the CPA does not vote with the board or participate in management functioning. Retired partners may impair independence after they left the firm, except those conditions relating to their retirements are satisfied. The person's retirement benefits are fixed. The person is no longer active in accounting firms. Some retired partners remain active, and the former partner is not held to be associated with the accounting firm by a reasonable observers. Accounting services. If a CPA performs the bookkeeping and makes accounting decisions for a company and the management does not know enough about the financial statements to take primary responsibility for them, the CPA cannot be considered independent for assurance services. The CPA can perform the bookkeeping and counsel the client management about the accounting principal choices, but in the final analysis, management must be able to take a primary responsibility for the statement. Work prohibited by Sir Oxley, Sarbanes-Oxley. That's a rule passed in US after the financial crisis of 2007. Includes internal audit, financial information design and implementation, and tax services. So these are other issues related to the independence principle. Is rotation of a partner and second partner review, rotation of the lead auditor, audit partner, or the concurring partner is required every 5 years. A second partner review is mandated by both SOX and the CPAB. These are the two laws. One is for Canada and one is for US. Actual or threatened litigation. PAs, public accountants, are considered not independent when the company management threaten or starts a suit against the PA, or when the PA threaten or starts a suit against the company. Like if they have any legal dispute and they are in the court of law, so in that case, that person cannot also work as an auditor. Investor or investee relationship, material investment by the PA and by the client needs to be considered. Effect of a family relationship, financial interest of a spouses and dependent persons, and some interest of a close relatives are attributed to the member. Analysis, objectivity and integrity are always required, but the rules concentrate on conflict of interest based on the financial measures. So conflict of interest should not be there. Professional competence and due care principles are required under the rule of conduct as well as under generally accepted auditing standards, GAAS. The professional competence and due care principles are a comprehensive statement of general standard that accountants are expected to observe in all areas of practice. So these principles that enforce the various series of professional standards, professional competence, due professional care, planning and supervision, and sufficient relevant data. Compliance with the professional standard. So public accountants shall perform professional services in accordance with generally accepted standard of practice for the profession. Extension and refinement of the due care principle. Practical effect of a rule is to make non-compliance with all technical standards subject to disciplinary proceedings. The failure to follow auditing standards, accounting and review standards, and insurances compilation and the professional conduct standard is a violation of this rule. So by this way, we discuss the second part as well.